Hello, friends, clients, and colleagues. Today is Tuesday, March 11th. This is Rich Siegel and Carl Mariner with ARQ Wealth Advisors. And we thought today is an opportune time to do another 5 and 5 market update. We're going to first take a quick look here at our disclaimer language. Feel free to pause this and read it if you'd like. And let's get into it. Hey, Carl, any reasons why today might be a good day to do a market update?
Yeah, thanks, Rich. As you may have noticed, the markets have been a little bit volatile over the last couple of weeks.
Yeah, a little bit.
Yeah, I think the rate at which policy is being rolled out right now and the administration is causing some level of uncertainty, and markets always dislike uncertainty. And so I think it's really led to some volatility and some selling of assets. And so we wanted to take some time to talk about that today.
Yeah, actually, I looked back at our commentary from last quarter, and we literally said on the first page on a bullet point that the level of policy change that they want to do will cause disruption, either positive or negative. And so far, we don't really know the outcome, but we do know that the market does not like uncertainty. So there's been some pickup lately in market to the downside and some volatility. Investors are rattled. So let's do 5 and 5, and it starts right now. I'll do the first slide. This is the VIX. The VIX is the fear indicator. The higher the VIX, the more fear. Today, we ended at about 27. We got as high as about 28 this morning, but this is the closing value. Historically speaking, the VIX averages around 18 to 20. And what's really interesting about the VIX is for every 16 points, that basically equals about 1% daily move in the market. So a 16 VIX means about a 1% move per day in the market. Translated to the Dow Jones Industrial Average, that's 400 points a day. A VIX of 32 then means 800 points a day swing in the market. So today we're in between those two levels. So to see 700 points a day is about normal. And as you can see here, we've come off a period of very low fear or complacency, right? And now we've kind of skyrocketed here. That's why it feels so uncomfortable. But don't forget, we've been at this level or above many times in the last few years, and we're still here to talk about it. Any thoughts, Carl?
Yeah, I really like this slide. I think it's important to frame what we're experiencing today. A lot of clients may feel some level of uncertainty, especially when we've seen markets move as much as they have. It's important to frame that in historical context. We're well within normal trading ranges. The point moves feel a little bit bigger today, but that's because the market is bigger than it was 5 years ago. On average, seeing 30 point or a VIX of a 30 is not uncommon at all. That's a relatively healthy market environment. And in fact, it creates good buying opportunities for disciplined investors.
Agreed. Studies show that adding to stock exposure in the high 20s to low 30s may not be the bottom, but it's usually a great entry point for future returns. All right, moving on to the next slide. I'll piggyback on that one and talk about stock market drawdowns or corrections. A correction is defined as a 10% or more drawdown. Typically happens about every 18 months or so. And you can see here that as of yesterday, we were down 9. Today, we actually kissed the 10% correction number momentarily and ended the day. So this is as of yesterday, minus 9.75. We can call this negative 10. So the S&P is actually in a correction for the first time in well over a year. The average correction per year is about 14%. That's the average since 1980. So these are very typical. Last year was 8, prior year 10, 25, etc. And an old analyst that I like, Tony Dwyer, used to say things like this: corrections are only natural, normal, and healthy until you're in the middle of one, and then it feels lousy. But basically, these drawdowns, unfortunately, are the price of admission for being invested in the stock market. You have to be able to handle some volatility to get the long-term returns and outcomes associated with investing in the stock market. Any thoughts?
Said differently, the returns we receive our compensation for the risk of enduring that volatility. And I think that's an important theme. It is a big premise of how we manage portfolios. I do think it's interesting to observe if you look across some of these historical years in the last 30 or 40 years, many of the years that see drawdowns north of 10% finish the year in positive return territory.
Exactly.
So
Exactly. Hmm.
this doesn't necessarily bode poorly for the markets.
Agreed. All right, moving on. Let's talk about some good news, perhaps, or some good signals.
Yeah, I wanted to touch briefly on what's happening in the price of oil. That may not be feeding through to your price at the pump yet, but it is worth acknowledging in the last 2 months, the price of crude oil is down almost 20%. It's around 17%. That's a signal from the market, a softening in future expectations of economic consumption. And so I think this slide is pretty important. The market's sending a signal that there may be some economic softening, and the good signal for us as consumers is the price of gasoline, the price of consumables may be coming down as a result of that. What are your thoughts, Rich?
Yeah, no, I agree. When gas prices are high, it's like a tax, and when they're cheap, it's a tailwind for the consumer. You fill up your gas tank for $60 instead of 90. That's a big deal for a lot of people. So I agree. And then to kind of piggyback on that, with this possible softening in economic output, also the bond market has made some interesting changes in dynamics recently as well.
Yeah, as I'm looking right now, we pulled some data as of yesterday's market close around where the market expects the Fed funds rate to be and where the Fed expects their Fed funds rate to be.
Mhm.
A really interesting dynamic is playing out. If we look at where we were a month ago, the market saw a less than 15% chance that we would end the year with three or more rate cuts. As of today, the market is pricing in a greater than 60% probability of that outcome. Rate cuts means debt gets cheaper. The cost of borrowing gets cheaper. And that helps us as consumers, that helps stimulate the economy. And so I think this is an important signal to pay attention to.
Agreed. Most consumers don't pay cash for things, they borrow. So if you could borrow at lower rates, it makes the payments more palatable for people, that car loans, mortgages, small business loans, et cetera. So although rates might be cut for the reason of a weakening economy, it also helps to stimulate the economy and the consumer. And it looks like we were at about 5.5% for the Fed funds rate just a year ago or so. And we may end the year closer to 3.5 or in the high threes. It's a big drop. And then the last slide, we could share this one. I'll start and say that on a net of fees basis through yesterday, ARQ Wealth's average client profile is barely negative for the year, negative 0.5%, which is not great to be down, but considering the recent carnage, we're quite proud of it. You can see here versus the S&P 500 or the NASDAQ or the Magnificent Seven. Tesla, for example, has really gotten hit hard lately. NVIDIA, we've held up quite well. What do you think that's attributed to, Carl?
Yeah, I love the title of this slide, Diversification Matters Eventually. Nobody loves being in a diversified portfolio in a year like last year where the S&P is up 24%. If you look through the portfolio this year, the things that are up are the diversifying assets. It's international equities, it's bonds, it's value-oriented stocks. So some of the themes that we've talked a lot about and built into our portfolio are the reason that our clients are doing well this year. And I'm very proud of that.
Yeah, international stocks have been a laggard for, I think, 13 out of 15 years on average, like in the past 15 years or so. And shockingly, I looked earlier, they're outperforming US stocks by double digits, I think 15%. It's pretty wild to see how the reversion to the mean is happening so quickly this year. Well, that's a wrap. Thank you very much for listening. We appreciate your time, and we'll speak to you soon.